An analyst over at PricewaterhouseCoopers called the post-stress test measures, quote, not too harsh. What would make it harsh enough?
Well, I agree with that. I don't think they were very harsh at all. I was hoping for them to just say, for now, let's just suspend dividends. Let's buy back dividends and discretionary bonuses. We need to conserve capital. We need to build balance sheets. Let's, towards the end of the year, we'll have a better sense of what's going on and maybe make adjustments as a result of further analysis. But to now, given the tremendous uncertainties, to be allowing banks to distribute any capital, I think is ill-advised. So I was pleased that they did take some steps, some minor steps. But frankly, I'm surprised the market reacted the way it did. I thought, if anybody thought dividends were going to increase, that was just unrealistic. And certainly buybacks are going to be a thing of the past for a while in any impacted industry. So I think the market should actually be happy about this. It was not harsh at all.
Sheila, talk to us a little bit about discretionary bonuses here. There's been a lot of talk about dividends, but what is the case to limit banker pay?
Right. Well, I think it's not a lot of money, but nonetheless, if your shareholders are taking a hit, I think management should as well. And it does conserve some capital. It aligns economic incentives. So I think it's appropriate. And it was part of the Basel, the post-Great Financial Crisis Basel II framework to have these automatic suspensions of shareholder distributions and discretionary bonuses when you get into highly distressed situations. So that was already part of the pre-existing framework that the Fed and other regulators have actually eased so that it is not kicking in at this point.
So remember earlier in the day yesterday, we did hear about the revised Volcker Rule here. How do you pair off the Fed's warning for the rest of the year with the idea that the banks could also be taking on more risk with these new Volcker rules?
Good question. The timing on a lot of this is really astonishing. So yes, this really opens the door for banks to take much bigger stakes in very high-risk funds, funds doing things that got them into trouble during the Great Financial Crisis. So it was pretty astonishing. And a public policy reason for doing that at all, particularly doing it now, when we want to make sure that banks are focused on Main Street lending, supporting the real economy, activity, not speculative, high-risk trading strategies. That's not where we want them to be focused, but this opens the door for a lot more of that now. So it was really astonishing.
Sheila, it's Guy in London. You just raised a whole load of issues, particularly that are germane for many people in the United States right now.
Right.
If you were Treasury Secretary, hypothetically, what would you do to change the relationship between the banks and society?
Well, I think probably the Secretary of the Treasury has a bully pulpit, but in terms of the relationship, I think it's much more with the Fed and the other banking regulators. I do think that we need to have better clarity around what is the role of banks. Banks have special deals with the government. They have deposit insurance. They have access to Fed lending facilities. Those with big investment and trading operations are benefiting a lot now from all of the Fed liquidity support that's being provided into financial markets. They have a special deal, but with that is special obligations to support the real economy, especially during downturns. And part of that is making some sacrifices like shareholder dividends and discretionary bonuses when you get into a situation like this. So I think clarifying that relationship and the role of banks and making sure bank leadership and bank culture understands that they have an obligation in return for these benefits they get through the government safety net has this obligation. And I think that the public is just very cynical about banks right now. And I think banks were hoping that this crisis would help rehabilitate them, but I don't think that's happening at all. I think all this deregulation is making people more cynical. I think the huge divide between the real economy and financial markets is making people more cynical about the banking system. I do wish people would differentiate between banks that, large, complex Wall Street banks that do a lot of investment banking and trading, and that's fine with that, but I'm not sure we need safety net support for that. And then the regional and community banks that are actually doing the bank lending, the kind that households and small businesses rely on. We can't access the corporate debt markets, right? So small businesses and households have to rely on banks. So understanding those distinctions and understanding those public obligations, I think is very important. And that is the tone that I think anybody in leadership, whether the Fed or the Treasury Department, should be setting.
And we're going to get to that in just one quick second. I just wanted to follow up. So a bully pulpit, though, might not be bad. So if someone were to say offer you the head of the Treasury, would you be interested in that job?
No, I would not. My years of government service are over. I'm enjoying doing what I'm doing now. I'm doing more writing. I've got several children's books coming out next year. So I'm very happy doing what I'm doing. I'm hoping to stay involved in public policy through writing and through relationships I have with people in government who are kind enough to reach out to me from time to time for advice. But I see that as my role. And I hope, look, I respect all the regulators who, and a lot of them I've known for years, but I do think this whole trend towards deregulation, which even continues now that we're in this terrible pandemic, is ill-advised. I think long-term it's going to hurt them and their agencies, and I really wish they would rethink some of the strategies they're using right now.
Sheila, I want to take on your regulator hat one more time on this one. What is keeping regulators from pushing further into overseeing the non-banks, where we've seen leverage really rise in the hedge fund industry and the private equity industry? Can there be greater limits there?
There could be, and I think that's another lesson, that there were some tools in Dodd-Frank that really were never used very aggressively. There are regulatory tools you can use as bank regulators in terms of the intersection of large banks with these non-bank hedge funds, private equity that are, the source of, frankly, some systemic risk in the system right now. So we haven't used those tools very well. I think, knock on wood, again, the Fed's liquidity facilities is papering over a lot of the problems that otherwise a lot of these funds would be experiencing. How long that will last, I don't know. Fingers crossed that the Fed can keep it up. But longer term, we get past this. We need to say it again. We need a holistic approach to financial oversight. And if somebody's acting like a bank, if they're using a lot of leverage, if they've got short-term liabilities and long-term assets, they need at least some basic safety and soundness prudential oversight, including capital requirements, which do not apply to most of them right now.
Do you think, Sheila, that on that note, that we need to think more about the way that government policy, particularly Fed policy, works right now? The Fed has done an awful lot since the start of this pandemic. And in some ways, and you alluded to this earlier, it is easy to perceive that as a rescue for Wall Street. Is that how you perceive it? They've bailed out companies by supporting the credit market. That has got to help the banks at some point. If you're sitting outside this world, how do we change that perception?
Well, I think the Fed has really tried this time to be more accessible to Main Street, but it's just hard. They don't really have the tools. First of all, as Jay Powell said, they lend. That's what they do. We really don't need more debt right now. Kind of have a lot of that already. Low interest rates, a lot of debt. Those are the tools they have. So we need to rethink monetary policy and use of money supply to support to support the real economy in times of economic turmoil. I've been a big advocate of digital currencies, central bank backed or issued digital currency that actually could be distributed directly to households in times of stress. Give them cash, don't give them more debt, and find out what technology will allow you today to have a transmission mechanism that goes directly into households. And obviously Congress needs to authorize that. There need to be very tight controls around it. But nonetheless, in a situation like that, we've seen how the government and the IRS on the fiscal side has struggled to get EIP funds to households. Those payments, notwithstanding some of the problems in transmitting the payments, have done a lot of good for the economy. And so, but having some type of automatic stabilizer where their cash could actually be distributed through digital wallets, which are fairly easy to set up right now, right into households, that would be so much more efficient than pumping all this money into financial markets and seeing this giant chasm between, what's going on with the stock and bond markets and what's going on with Main Street.
Sheila, the digital currency idea is super interesting because there's a real concern that the U.S. is behind, especially compared with other countries, notably China. Are you concerned about that race to create a digital currency?
Well, I am. I think, we are privileged to have the world's global reserve currency. I don't see that changing anytime soon, but I do think one of the undercurrents of what China is doing, at least especially in developed countries that have unstable currencies, is to default to the RMB, as the currency of choice that they're using in their own countries, through their central bank's digital currency. So yeah, I think that's exactly what's going on. I think we need to wake up to it. We shouldn't be too complacent about our leadership position. I think, or the strength of our system, the strength of our Fed and its independence and its integrity, I think will always give us the edge. But we need to effectively use this technology. Domestically, I think it's urgently needed, but we should also think about how the dollar is used throughout the world. The other thing nice about digital currency, if it's cryptocurrency, if it's traded on a distributed ledger, you have a much better audit trail of transactions. So from a law enforcement perspective, kind of there's urban legend that somehow it makes illicit transactions easier. Actually, it makes it harder, because with the central bank issued or backed digital currency, you can actually trace the transactions, where that digital money is going through the distributed ledger. So from a law enforcement perspective, it also has huge advantages. But we do need to be very aware of what's going on in other countries and the real risk that is posed to us if we don't effectively leverage what is happening now. I mean, I think in 12 and 18 months, we could probably have a system of digital currency if people really put their mind to it. And again, it needs to be authorized by Congress. But the Fed, I know, has been looking at it for a while, and I think we need to accelerate that.